Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're taking on a really fascinating deep dive. It forces us to look beyond just simple stock tickers. We need to investigate an entire energy ecosystem. Antero Resources, that's ticker AR, and Antero Midstream, ticker AM.
Yeah, this is a crucial pair trade. And for you, the listener, it's kind of a masterclass in risk mitigation, especially in the, well, volatile natural gas sector. We aren't just analyzing two separate companies here. We are looking at an interconnected, integrated value chain. It's really designed to capture every possible margin dollar, from the moment the molecule leaves the ground until it actually hits a premium market.
Okay, let's unpack this core thesis right away then. The investment case here, it seems, is really predicated on the fact that these two companies, AR and AM, they operate almost like a single unit, deep within the Appalachian Basin, right? They're coupled to create this powerful synergistic effect.
Absolutely. So Antero Resources, AR, that's your upstream E&P, the exploration and production company. Think of them as the engine. Their role is the difficult part. High risk, potentially high reward. Finding and extracting the high-quality natural gas and, importantly, the natural gas liquids, the NGLs. They bring the production risk, yeah, definitely, but also that massive potential growth that comes with commodity upside.
And Antero Midstream, AM, that's the stability anchor.
Yeah.
This is where the risk mitigation really comes in, I gather. They're the midstream provider, so we're talking infrastructure, like gathering lines, the big compression stations, and also the complex water services needed to get AR's product actually ready for market. They basically turn AR's volume into stable, high-margin fee revenues. Is that about right?
That's exactly it. And it's vital to note AM is structured as a master limited partnership, an MLP. Now, for those maybe unfamiliar, an MLP is a specific tax structure. It usually requires the company to distribute nearly all of its available cash flow. It's really an infrastructure play. It's designed not necessarily for rapid growth, but to provide high, stable, often tax-deferred yield. This makes AM fundamentally different from the growth-oriented, capital-intensive AR, and that's precisely why the coupling works so well. AR drives the volume, and AM generates the predictable income.
Okay, so the ultimate takeaway for you, the investor listening, is that this integrated structure is deliberately designed. It's meant to de-risk your exposure to that volatile upstream performance. They sort of take the commodity roller coaster ride that AR faces, and they lock it into predictable, inflation-adjusted, fee-based midstream cash flow for AM. And you mentioned AR holds a big stake in AM, too.
That's right, a significant 29% equity interest in AM, which further cements that alignment of incentives between the two.
Got it. Okay, now let's maybe zoom out a bit to the macro context, because the tailwinds you mentioned here sound pretty structural, pretty profound. Why focus on natural gas right now specifically?
Well, because we are basically in the middle of a global energy shift, and it's driving unprecedented demand, really unprecedented.
Right, the AI revolution gets all the headlines, for algorithms and chips. But if you look closer, you realize the AI revolution is fundamentally an energy revolution, isn't it? We're seeing massive, almost exponential power in infrastructure demand. It's driven by these data centers that need to run 24/7. And this need for reliable baseload power translates directly into huge demand for natural gas.
Oh, absolutely. When you look at utility forecasts, they're struggling to keep up. An AI data center, it's not like a typical office building load. It requires industrial scale, always on power. And since renewables are intermittent, right, and nuclear is just slow to build, natural gas is really the only viable, dispatchable fuel source that can scale quickly enough to meet this, exponential AI demand growth over the next decade or so.
And it's not just data centers either, is it? We're seeing this sort of industrial renaissance across North America, petrochemicals, manufacturing. It's creating huge new domestic energy consumption points.
Exactly. And analysts are concluding that these massive tailwinds from the AI boom and, reshoring manufacturing, it's creating a growing upside risk that economic growth might actually reaccelerate over the coming quarters. And energy, specifically natural gas, is really the bedrock of that potential reacceleration.
Okay, and then there's the export piece, validating that long-term picture. Liquefied natural gas, LNG.
Huge, massive global demand from LNG exports. The U.S. is a major player, obviously, and AR is exceptionally well-positioned here. They hold a distinct Northeast LPG export advantage. Crucially, their export capacity is specifically not impacted by those near-term U.S. Gulf Coast capacity constraints you hear about. They've secured pipeline access to global markets for their products, including those valuable natural gas liquids and GLs.
That market access sounds huge, and it probably ties directly into why analysts are getting so bullish on the commodity price itself.
Absolutely. The old environment, the common post-shale revolution $3 Henry Hub range, that seems structurally broken now. Analysts are expecting Henry Hub natural gas prices to see consistent swings, maybe in the $5 to $7 range in the years ahead. The new structural demand, validated by AI, validated by LNG, it's pushing up the floor for the entire commodity.
Wow. And if you can actually get prices consistently in that higher range, the profitability for high-efficiency producers like AR must become, well, almost unbelievable.
Exactly. Which is why we need to transition now and look at the engine itself. Let's dive into AR.
Okay, so if that macro picture truly supports Henry Hub prices shifting up towards that $5 to $7 range, that presents a massive opportunity for the producer who can actually execute, right? So let's now look at Antero Resources, AR, the company tasked with capitalizing on that volatile but potentially rewarding upside. This is the E&P company, the one responsible for pulling the gas and liquids out of the ground.
That's right. AR operates exclusively in the Appalachian Basin, primarily focusing on the liquids-rich Marcellus Shale, that's mostly West Virginia and Ohio. And this focus on liquids-rich is really key.
Why is that so important, the liquids part?
Because NGLs, natural gas liquids like ethane, propane, butane, they often command far higher margins than dry natural gas alone. So this dual production stream kind of insulates AR from the worst Henry Hub swings. It boosts their overall realized pricing.
Okay. And we need to anchor our understanding of AR's current health with the recent results, right?
Yeah.
Looking at the 9 months ended September 30, 2025, the financial improvement looks staggering. It really demonstrates their leverage to that price upswing you mentioned. AR swung from a net loss of over $65 million for the same period in 2024 to a net profit of over $471 million in 2025. I mean, that is a massive profitability swing in just 12 months.
It is, and that swing is basically a result of operational excellence meeting higher prices. AR is setting operational records that reflect sheer efficiency and scale. It's pretty impressive. They drilled the longest lateral in company history. We're talking well bores stretching over 22,000 feet.
22,000 feet.
Yeah, which is, roughly 4 miles underground.
4 miles. That's an incredible length for a horizontal well. What does drilling laterals that long actually achieve for them financially?
Well, it dramatically lowers their completed well costs on a per unit basis. That's the key. They spend the capital to drill the vertical hole and build the pad just once, right? But they get 4 miles of reservoir exposure and production volume from that single setup. They're also averaging the highest completion stages per day currently. This kind of machine-like precision allows them to bring on volumes faster and cheaper than many of their regional competitors. And that directly contributes to that significant profitability swing we just saw.
Okay, and it's important to note their environmental stewardship too, especially in a regulatory environment that's only getting tighter. Antero Resources' methane leak loss rate in 2023 was only 0.0111%. That sounds incredibly low.
It is. It's significantly below the voluntary industry target of 1% set by this group called One Future. And that 0.011% leak rate isn't just, a good deed for the environment. It's a profound financial advantage.
How so?
Well, every molecule of gas they capture is a molecule they can sell, right?
Yeah.
So this high capture rate, it lowers their operational compliance costs, it boosts their ESG scores, which is increasingly important for attracting institutional capital, and potentially it allows them to market their gas as low carbon certified, maybe realizing a direct price premium over less efficient competitors.
Right, right. And this captured high-efficiency gas is then directed to premium markets. You said that's AR's primary competitive advantage. Realized pricing.
Exactly. Their leading natural gas realized pricing is attributable to their exposure to NYMEX-linked markets. And that's supported by having 75% firm transportation capacity dedicated specifically to LNG exports. They simply aren't stuck selling into cheap local markets. They've secured that long-term access to global benchmarks.
Okay, moving to capital allocation then. AR seems to have shown remarkable balance sheet discipline while using that substantial free cash flow.
They really have. Since 2019, they've achieved approximately $2.7 billion in debt reduction. That's huge. As of mid-2025, their net leverage ratio was a very low 0.8x.
0.8. That's outstanding. It means their debt load is less than their annual earnings power, basically.
Pretty much. And crucially, they've earned investment-grade ratings from both S&P BBB and Fitch BBB.
Okay, why should the listener care about a few rating letters? What's the practical impact?
because that rating allows them to borrow capital far cheaper than their, junk-rated peers. They have a significant cost of capital advantage when they need to expand or strategically execute bolt-on acquisitions. This financial flexibility means when they need more land or maybe need to accelerate drilling, they can do so cheaply and efficiently, which, frankly, few E&P firms can boast these days, and they are using this free cash flow strategically for share repurchases as well. They returned about $163 million to shareholders year-to-date in 2025.
Okay. And looking ahead, their immediate growth driver seems to be expanding their land capital budget by $50 million.
That's right. They're focusing this capital specifically on the liquids-rich Marcellus Fairway. The goal is to secure future volume growth. They boast having greater than 20 years of premium drilling inventory.
20 years. That provides immense runway for the midstream partner AM, doesn't it?
It absolutely does. It underpins that whole relationship.
But as we promised, we must define the risk, the primary inherent risk for AR. It's still commodity price volatility, right? Even with their great transport strategy.
Absolutely. They are highly sensitive to swings because of that leverage we just discussed. High highs, potentially low lows if prices crater.
And the sensitivity numbers really underscore this sharp leverage. Based on their production for the 9 months ending September 30, 2025, a mere $0.10 decrease per MMBtu in natural gas prices. Paired with just a $1 decrease per barrel in oil and NGLs prices, that would decrease revenues by a significant $112 million. That shows how quickly even minor price fluctuations translate into massive revenue changes for them.
Yeah, the operating leverage cuts both ways. And we can't overlook the regulatory and litigation exposure either. On the regulatory side, they face new, stricter EPA methane rules, specifically these OOB rules for new facilities and OOB for existing sources.
OOB and OO. Sounds technical. What's the core issue there?
The core issue is that the EPA is demanding much stricter, often continuous monitoring of leaks across the board.
Even with AR's already excellent record of 0.011% leakage, compliance with these enhanced leak detection requirements probably means new costs.
For sure. It means new capital spending, implementing new technology, potentially higher operating costs across the entire industry, not just AR. It effectively places a new cost floor on every producer, which might actually benefit the most efficient ones like AR in the long run, but it's still a cost.
Okay. And then there's the litigation. Something about post-production costs.
Yeah, concerning post-production costs deducted from royalty payments in West Virginia and Ohio. It's known as the ongoing Romeo matter. This is crucial because it potentially sets a legal precedent. After a really complex series of court decisions, the ruling effectively broadens the scope of products for which AR will have to pay royalties. And it limits the post-production costs the company can deduct under certain older leases they hold.
That sounds like it could be a financial landmine, potentially. While AR accrued only an immaterial amount for estimated damages as of September 30, 2025, the actual long-term implication is maybe the financial uncertainty this creates for future royalty payments on those specific leases.
Exactly. If the principle of netting back cost-deducting transport and processing costs before calculating royalties is significantly challenged, it could erode profitability on the margin for certain legacy assets across the whole basin. It's a risk that impacts the entire E&P space there, but AR, being concentrated in the Appalachian Basin, feels that pressure acutely. It's something to watch.
All right, switching gears now, let's move over to Antero Midstream, AM. This is the stability anchor in this pair trade, right? This is where the risk is supposedly defined away and predictable high cash flows are generated.
That's the idea. AM operates in two core reportable segments, gathering and compression and water handling. And as we mentioned, they are set up as an MLP, making them fundamentally an infrastructure play. Their entire existence is basically predicated on handling AR's volumes under extremely sticky long-term contracts.
And that contractual foundation is the absolute bedrock of AM stability, you're saying. We're not talking small parcels here. Nearly all of AR's acreage in the Appalachian Basin, something like 567,000 gross acres, is dedicated exclusively to AM. That means virtually every new AR drills has to use AM's infrastructure.
That's correct. And these aren't just loose commitments. They are high-margin, long-term, fee-based contracts. Critically, the contracts are often subject to annual CPI-based adjustments. That ensures they keep pace with inflation. For instance, their water services agreement runs all the way through 2035.
Wow, 2035.
Yeah, this ensures revenue growth even if volumes were to flatten out momentarily for some reason.
And what's fascinating are these built-in safeguards you mentioned for new construction. when AR asks AM to build something new.
AM is heavily protected. They basically have an election, a choice. They can either impose minimum volume commitments, MVCs. These require AR to essentially use or pay for 70% to 75% of the new capacity for a decade.
Use or pay.
Or, if MVCs aren't applicable for some reason, they can institute a cost of service fee instead. This fee literally allows AM to earn a mandated 13% rate of return on that new construction over 7 years.
A 13% guaranteed return.
On certain new construction projects, yes. This is sort of the magic of that dedicated midstream structure. AM is effectively protected against AR suddenly cutting back operations on those specific new builds. It's a fee-based return, not volume-dependent risk, which really locks in stability and return for AM shareholders.
That guarantee of return provides incredible financial stability. Looking at their Q3 2025 financials, we see the result of this structure combined with AR's growth, right? Total AM revenue increased by $72 million for the 9 months, ended September 30, 2025. And this wasn't just higher throughput. It was throughput combined with those CPI-based rate increases you talked about.
Exactly. And their operational efficiency is driving superior financial metrics, too. We saw 10% adjusted EBITDA growth, which is solid. But what really jumps out is the massive 94% increase in free cash flow after dividends.
94% increase after paying the dividend.
Yeah. This shows the operational gearing is working really well. It's translating those increased volumes directly into distributable cash flow.
Good. We can break down that $72 million revenue increase by segment too. Gathering and processing revenue accounted for a $45 million bump. But the water handling segment, which increased by $27 million, you said that's often an underrated efficiency story.
It really is, and it's absolutely critical to AR's competitiveness. That revenue increase was due to a significant 30% increase in freshwater delivery volumes. That's up 2 million barrels, or about 21,000 barrels per day, in Q3 2025 versus Q3 2024. And freshwater delivered by pipeline is absolutely essential for AR's completion activities, primarily hydraulic fracturing.
Wait, why is pipeline water delivery so important compared to just trucking it in, which I guess is what many other producers do?
Because it's drastically cheaper and much more reliable. Trucking water is a huge logistical bottleneck, especially in that Appalachian terrain. It's costly, it's slow, it clogs roads. By using dedicated pipelines for freshwater delivery and also handling the complex wastewater and flowback fluids, AM ensures AR has the water it needs exactly when it needs it, efficiently. This directly translates to AR being one of the lowest cost producers in the basin, which in turn benefits AM through sustained drilling activity from AR. It's really a perfect operational closed loop.
Makes sense. Okay, on the balance sheet side for AM, they've been prioritizing capital return and stability.
They have. They successfully reduced their net leverage down to 2.7x. That's a significant improvement for an MLP structure, gets them closer to that IG-like profile. They've also been very strategic about extending their maturity runway.
How so?
Well, they refinanced their nearest-term debt maturity. They redeemed $650 million of 2027 senior notes and successfully issued new notes that are due way out in 2033.
2033, that's 8 years of breathing room.
Exactly. That gives them excellent financial flexibility and demonstrates a real commitment to long-term stability rather than short-term reliance on fickle debt markets.
And for investors focused purely on yield, that focus on stability translates directly to the return, right? AM declared a cash dividend of $0.2250 per share for Q3 2025, which means they maintain a very attractive, 5% plus yield profile for investors prioritizing reliable cash flow.
That's right, a solid yield. And there is also a bit of a growth opportunity embedded in their existing dry gas midstream capacity. They plan to redeploy about 0.2 BCFD of compression capacity that had previously been taken offline. This reuse of underutilized equipment likely in the dry gas window of the Marcellus Shale signals future expansion potential. And importantly, without having to build entirely new infrastructure from scratch, it lets them capitalize on AR's long-term drilling inventory more efficiently.
Okay, but let's define the key risks for AM as well. The number one risk is got to be absolute concentration risk, doesn't it? Substantially, all of AM's revenue is derived from transactions with just one customer, AR.
That's the primary risk, yes. If AR reduces its drilling activity, say, due to a sustained severe drop in commodity prices, AM's cash flows are directly and adversely affected. It's essentially a single customer risk profile.
So it's the risk of non-payment or non-performance by their core customer. Even with those strong contracts you mentioned, the MVCs and cost of service fees. If AR were to face severe financial distress, or even, worst-case, bankruptcy proceedings, AM's contracts could be subject to renegotiation or even rejection under the U.S. bankruptcy code, right? Which would destabilize AM instantly.
That is the ultimate downside risk, yes. And compounding that is the corporate conflict risk. This is something any minority investor in AM really has to grapple with. Remember, AR is AM's largest shareholder, owning 29% of the common stock. More importantly, all of AM's officers and certain directors are also officers and directors of AR.
Ah, okay. So there's the fiduciary duty conflict. Those shared individuals owe their primary duty to AR, the producing company, first and foremost. This creates inherent conflicts where maybe strategy is favoring AR, like demanding lower fee structures from AM or delaying new infrastructure builds AM needs. Those could potentially be detrimental to the minority shareholders of AM who are really just relying on that stable yield.
That's the inherent conflict, yes.
This sounds pretty serious then. If AR management can potentially push for decisions that benefit AR but hurt AM's yield, how does an outside AM investor protect their yield? Is there like an independent committee on AM's board that safeguards minority interests, or is this just an accepted known risk in this kind of MLP structure?
It is generally an accepted risk in this specific integrated model. Typically, an MLP will have governance measures in place, often including an independent conflicts committee to review related party transactions. However, at the end of the day, the success, the very viability of AM, is completely tied to the success of AR. So the best protection for the AM investor is really AR's continued financial health, its operational efficiency, and its ongoing commitment to the long-term integrated plan that benefits both entities. Their fates are intertwined.
Okay, now we get to the synthesis part. This is where we really pay off that core thesis we started with. Why buy the pair? Let's zoom back in on that synergistic relationship that makes this an integrated value chain, where hopefully the whole is truly greater than the sum of its parts.
Right. Let's start by defining AM's irreplaceable value to AR. What does AM do for AR? AM provides guaranteed, efficient midstream access for all of AR's products, gas, and NGLs. It connects them directly to those premium markets and export facilities we talked about. This integrated internal logistical system minimizes AR's dependency on third-party pipelines or processors, which is exactly what enables AR to maintain its premium realized pricing consistently above many regional competitors. If AR had to rely on a patchwork of external midstream providers, its margins would shrink immediately, no question.
Okay, and conversely, AR's value to AM is the sheer volume and the stability it provides. AR's long-term production outlook and that dedication commitment, backed by that vast dedicated acreage. It provides AM with stable, predictable, fee-based cash flow.
Exactly. And those contracts, with their built-in minimum volume commitments or the cost of service fee options, guaranteeing that 13% rate of return on certain new assets, those are paramount to AM's high cash flow generation. Essentially, AR's growth directly underwrites AM's yield and stability.
Okay, so this creates a really tightly knit integrated development strategy. You mentioned the water systems as a prime example.
Perfect example. AR dedicates new drilling locations, say in the liquids-rich Marcellus Fairway, to AM. Immediately, AM invests in building the corresponding integrated water systems needed for those wells.
Right, and we talked about the operational advantage of those dedicated water systems, the pipeline delivery of fresh water, the handling of flowback and produced water. This coordination means AM is effectively underwriting AR's drilling efficiency, isn't it? By minimizing those huge logistical costs associated with water, which is a massive, necessary component of hydraulic fracturing. AM ensures AR maintains its position as a low-cost producer.
Precisely. It guarantees development reliability and consistency for AR. And in turn, because AR can drill and complete wells more efficiently and cheaply, it brings more profitable volume online faster, which immediately generates more fee revenue for AM. It's like an internal perpetual motion machine geared towards efficiency and stability for both sides.
Okay, so when we synthesize all these findings, the investment verdict starts to crystallize. We have AR, the growth engine. It's positioned to capture potentially huge commodity price upside. But it carries that high production and volatility risk, albeit offset somewhat by its financial strength and premium pricing strategy. Then we have AM, the stability anchor, generating high, predictable cash flow from its low-risk, infrastructure-backed fee stream, underpinned by those rock-solid long-term contracts with AR. The growth of AR directly feeds the yield of AM, which in turn, through providing lower operational costs for things like water, supports the ongoing efficiency and competitiveness of AR.
So the integrated model really minimizes execution risk, specifically within the challenging environment of the Appalachian Basin, by capturing the entire value chain from the drilling rig all the way to the premium export terminal. The pair trade seems positioned perfectly for the long-term structural energy demands we're seeing, Driven by AI, industrial renaissance, LNG. I think that's right. It allows you, the investor, to participate in the excitement of a growth E&P player, and importantly, one with environment-grade balance sheet strength, which is rare, while simultaneously having the insulation, the buffer of a steady midstream partner whose cash flow is contractually secured by the producer's long-term operational plan.
Yeah.
This structure effectively de-risks the overall investment, making that inherent volatility in the E&P sector potentially easier to swallow.
Risk defined. Portfolio protected.
Oh, buddy. Okay, as we wrap up this deep dive on AR and AM, let's leave you with one final thought, something that kind of ties the whole macro picture together with the specific investment case we just discussed.
Yeah, we talked a lot about the AI-driven demand boom,
Yeah.
but the big picture implication here is how this demand is fundamentally transforming the physical structure of energy consumption itself. The growing trend we are seeing now is that large energy consumers, especially these major data center operators, they're starting to bypass the traditional utility grid entirely.
Bypassing the grid. Why? Well, they realize the existing utility grid often cannot keep pace with this unprecedented power consumption growth, especially guaranteeing the 24/7 reliability they absolutely need. So they aren't just plugging into the existing infrastructure anymore. In some cases, they are building their own power ecosystems, often constructing dedicated natural gas power plants right alongside their data centers. This is sometimes called captive power.
Wow, building their own power plant.
Exactly. And this transformation emphasizes the long-term structural tailwind for natural gas and, crucially, for integrated delivery mechanisms like the ARAM setup. When major tech customers feel they have to build their own dedicated generation infrastructure, it guarantees demand for the fuel source needed to run it reliably, which is overwhelmingly natural gas for baseload power. This makes integrated producers and midstream providers like AR and AM, who can reliably deliver the necessary molecules directly to that plant next door via highly efficient pipeline networks. It makes them exceptionally valuable partners.
So the takeaway here is pretty stark then. When AI needs power, it doesn't necessarily wait for the aging grid to catch up. It might just build its own infrastructure and demand guaranteed fuel supply directly. The stability of your tech portfolio, in a way, might depend less on the software inside the data center, and more on who reliably delivers the natural gas molecules to the power plant right next door. This isn't just an energy play anymore. It's becoming a new logistics reality for the digital age. Something to consider. How this integrated approach we discussed fundamentally addresses the volatility inherent in the E&P sector, potentially turning commodity volume risk into stabilized infrastructure returns for the years to come.